everyone. I'm Janet Truncale, and I'm honored to be here today moderating what we expect to be a very insightful panel on ESG. I serve as Vice Chair and Regional Managing Partner of EY's America's Financial Services Organization. In addition, I am proud to serve as the Board Chair for Women's World Banking, a global nonprofit devoted to giving low-income women access to financial resources that they require to build security and prosperity around the globe. At EY, we see as our collective mission, and we act on our commitment to build a better working world. And we recognize that combating climate change is a vital element of building that better working world. ESG is a critical component to that effort. As the business world and investment community have evolved from a focus on short-term financial performance to the broader concept of stakeholder capitalism and long-term value creation, ESG has taken center stage. With our emergence from the pandemic, there is an opportunity to rethink the economy and move toward more sustainable practices to build back better. I'm proud to say that EY is one of the firms helping to spearhead this change. We recently announced our ambition to be carbon negative in 2021 and to be net zero in 2025, as well as to help organizations across industries to blaze new trails to create value from sustainability. The combined impacts of climate change, COVID-19, and economic inequality contribute to the urgency for businesses and investors to enhance long-term sustainable value creation and to prioritize the needs of people and planet and the generation of broad-based economic prosperity. So how can we advance these worthy goals? I'm joined today by three fantastic panelists to tackle some of the key issues around ESG from multiple perspectives. First, we have Kalpesh Kapadia, co-founder and CEO of Deserve. Deserve is a next-generation analytics-based fintech company. Through machine learning and alternative data, Deserve is focused on helping millennials and Gen Zs gain independence via access to fair credit products. Deserve's mission to democratize credit for all was built on Kalpesh's own struggles as a foreign exchange student from India seeking to access credit, and I'm hopeful that he'll share some of that with you today. Next, we have Lincoln Payton, CEO and board member of Cleartrace. Cleartrace is an energy, data, and carbon accounting platform which provides companies with digital infrastructure to enable decisions to mitigate financial risk, prove climate achievements, and create new market opportunities with the evolving energy landscape. Cleartrace recognizes that being a leader in sustainability now requires proving those claims with hard data. Lincoln is a senior finance and energy executive who brings to his role at Cleartrace experience in domestic and international corporate finance, principal investing, and risk management. And lastly, our very own Brandon Sutcliffe from EY. Brandon leads EY's sustainable finance activities in the Americas for our financial service businesses. Prior to EY, Brandon specialized in the energy services industry, working with large multi-facility commercial, industrial, and governmental clients to save money on their energy bills and reduce their carbon footprint. So please join me in welcoming our panelists to this discussion. So after meeting with all of our panelists last week, I really wanted to start off the discussion today around purpose. We can't talk about ESG without talking about corporate purpose and personal purpose. And each of you has such an exceptional story about what brought you to either found or join your individual organizations. And so I was hoping that each of you could start off by sharing your own personal journey around purpose and ESG. So Kalpesh, why don't I start with you?
Thanks. I came to America 26 years ago to do my master's in engineering and an MBA. And although I came from a relatively affluent financial background and a top 1% of academic background, I was sitting in the same classroom as my American classmates and not getting access to financial products such as a student loan or a credit card. And that prompted me to sort of look at the whole system of origination, underwriting, managing, servicing credit. And what I found over the years is that it was built on what 3 Fs I call, FICO, first data, and fees. And that was failing large swath of population which was otherwise deserving but underserved by the current financial system. Over the years, many of my family members and friends had come from India to study and work, and the problem had compounded due to regulations post 9/11, post financial crisis in 2008, and it was increasingly difficult for these folks to get access to credit. And that was the premise with which I started the company, to make it fair for deserving but underserved population who are otherwise discarded as invisibles by the financial system because of lack of credit scores, lack of social security numbers. And with that, we started the company, and our purpose was to provide fair access to credit to deserving but underserved population and lead them to financial independence. So access, advocacy, and independence were the three tenets of our founding as a company.
Oh, that's great. Great. And I love that story. And thank you for sharing with the broader group. Lincoln, why don't I turn it over to you?
Yes, thank you. That's a great story, Kalpesh. Look, I'll take it from the professional angle, if you like. Most of my working career has been in financial services. I ran the energy franchise globally for a major international bank. And during that time, Janet, a lot of advising, financing, risk management around hydrocarbon-based, renewable, also power industry. And the constant throughout that, particularly in the power and renewable space, was the fact that there was a woeful lack of data. So as I've seen the opportunity with Cleartrace to address that by concretely looking at the quality of data, and if one can produce immutable, provable records of consumption and generation, one can genuinely change the picture here. The energy profile moving in the direction of the real world that we want it to be, the renewable world, but measuring provably, transparently, and therefore that is what moves markets, when there is real transparent energy reported, and markets can then respond by putting a premium on green energy that all stakeholders in society want today. I saw that opportunity to tangibly move things, and I'm excited to be doing that. And at Cleartrace, I do believe that this will move the needle in an area where there's all the right motivations now, ESG, but we badly need metrics that we can target and achieve across all aspects of society. So I'm excited to be doing this.
That's great. And I know we'll talk a lot more about that as we go. And then lastly, Brandon, how about your personal and corporate purpose?
Yeah, I think I'll stick mainly to the corporate purpose. Those are great stories, Kalpesh and Lincoln. When I started my career, probably longer ago than I'd like to admit, almost 30 years ago, it was to work for an energy services company, as you mentioned in your introduction, Janet. At the time, protecting the environment was more of an ancillary benefit that came through the implementation of energy efficient equipment, not for the primary driver of change. And when I joined EY over 17 years ago now, its purpose of building a better working world wasn't articulated necessarily in that way, but the culture was there to support it. And it's really why I continue to enjoy coming to work every day, or I guess staying at home every day at this point. But what really keeps me motivated is the fact that the primary driver has changed, right? It's changed from sort of where I started my career and the dollars and cents to more about saving the planet from both not only an environmental perspective, but also from a societal perspective. And the fact that I can be a part of that type of solution and helping our clients and the community is really, truly rewarding.
Yeah, no, I agree. Thank you for all that and for sharing. And I know many of our listeners are feeling the same way, that there's an opportunity to do good while doing well. So let's turn to a different topic, but all related. And that's about the Biden administration, and one of the major focus areas with the new administration is in fact addressing climate change. And so with plans to rejoin the Paris Climate Agreement, establishing the National Climate Task Force, amongst many other plans, really like to understand what's the nature of the conversations that you're having with your clients on climate change, and then touch upon, are we seeing a change in the sense of urgency around these discussions in the last couple of weeks and months than as compared to prior? So Lincoln, why don't I start with you on that very question?
Yes, with pleasure. I think our clients understand that climate change is a critical issue and it's an urgent issue that they need to be addressing. I think we all see over a quarter of Fortune 500 companies have made public commitments to net zero or carbon neutrality one way or another in the relatively short term. And goes back to that point of what is a science-based emission reduction target? How do we define that? And so that nearly fourfold increase since 2015, when the Paris Climate Agreement first came out, in terms of major corporate entities targeting carbon emissions, shows that they really do understand the urgency and the nature of the issue and are with good intention trying to address it. So that's kind of the stakeholder side of the equation. The second, I think, part that the clients understand is the regulatory environment. And that maybe goes very much, Janet, to your question about the change in administration. We have some regulatory movement, but I think it's going to accelerate. We're seeing it accelerate already. A perfect example of that is in New York City, where we do a fair bit of work. And our clients are aware that there is already regulations, local law 97 on the books that requires certain hurdles of carbon footprinting for commercial real estate, one of the major greenhouse gas factor emitters. And if they're not able to show and use tools to get under those carbon footprint targets, there will be tangible costs. So you've got the two sides. You've got the reputational and the stakeholder and the doing the right thing side, and you've got the regulatory side coming together. The reason why we're having the dialogue with the clients that we're having is those two factors come together because there is the recognition there is a need for clear and transparent data and objectivity here, as opposed to just nice words and well-intentioned statements. And even around the point I started with, which is the Fortune 500 positive statements targeting, there is a lot of ambiguity around those statements. And what I believe Cleartrace does is provide high quality, clear data that allows the matching of consumption and production of green energy, and therefore an accurate carbon footprint. And I think metrics will solve our or start to solve our problem.
Yeah, that's great. I know, Brandon, I'm sure you have some thoughts on that too. I did mention in our opening remarks, we also made some pretty bold statements at EY in terms of our plans. But Brandon, what are we seeing across the board from a client perspective? And then again, have you seen momentum in the last couple of weeks and months compared to prior?
Yeah, there's definitely, Janet, a greater sense of urgency and focus, with the new administration coming on board, and we're seeing accelerating discussions. I mean, the nature of those conversations are a lot like what Lincoln had referred to. I think, for us, they vary depending upon the size and complexity of the specific organization and whom within those financial institutions that we're working with, that we're speaking with, right? But they range from what Lincoln referred to as those, commitments, or, setting how institutions are setting those goals, how they're monitoring those commitments to help finance the transition to a lower carbon economy, to really help try to create the long-term value for their own firms, to how they embed the impacts of climate change into really everything that they do. And I think that's not only the administration's expectations, those are the regulatory expectations, really all across the globe, as well as here in the US. And, I think we're seeing, establishments of new governance structures to manage the risk. Several institutions have created a climate risk executive that reports directly up into the chief risk officer, as an example. And all institutions are really having to figure out how to factor the impacts of climate change into their credit underwriting decisions, right? And who they're going to lend to. But it's not all about risk. It's, some of those conversations are about the opportunities, because there are significant opportunities to help finance this transition, whether that's through renewable projects, as an example, or opportunities to create new products like ESG linked loans. But so at the end of the day, I think there's really no road to a net zero economy without financial services, as companies really need the funding and insurance to manage some of those physical and transition risks that Lincoln highlighted. And in fact, if I recall correctly, and I hope I am, the International Energy Agency, I think, projects the need for at least 3.5 trillion in annual global investments to really build the infrastructure needed for a green economy.
Oh, that's great. And we're going to come back to a couple of those thoughts in a moment. But for now, let's pivot a little bit to the S in ESG. And so another focus of the administration has been all around social justice, racial equality, and financial inclusion, Kalpesh, which I know is near and dear to you. And with COVID-19, it's also brought to the forefront the significant risks to which our most vulnerable groups are exposed, which is also motivating organizations to focus more intensely on addressing these issues as well around financial inclusion. So Kalpesh, how are organizations like yours, so technology firms, fintechs, and even the broader financial services institutions, really helping to propel the administration's agenda on financial inclusion? And I know you have some real great stories about that and deserve.
Yeah, so I wanted to touch upon the last point, although we are not in the sort of the environmental climate change focused industry, but in a very indirect but a profound way, it affects us and our customers. So when I think about front end, we encourage when our customers sign up for a credit card is to go green, go digital, go paperless. And we give them incentive to go paperless. And on the back end, during COVID, a lot of merchants were not accepting cash. And the plastic that is used to build credit cards was in backlog and back order because of some factories around the world shut down. So you had to go digital. So the trend of going end-to-end digital became accelerated. And we are the only company outside of Apple has complete digital experience from start to finish. You don't have to mail in a check or get a card in the mail or agreements, cardholder agreements, or paper statement or anything like that. Everything is digital, everything is mobile. So in some ways, I think many industries are getting affected by climate change, and you wouldn't think credit cards would be affected by that, but it is.
Yes, thanks for that reminder.
If you want a fancy metal card, you have to wait for 6 months. So that's one sort of corollary to what people are talking about here. And on the inclusion side, we are all about financial inclusion. And you look at how many people are being disadvantaged by the current rigid FICO-based credit system. To us, if you're new to credit, new to country, and it sort of touch upon the immigration aspect of it as well. You can get access to credit through us. We are all about approving more people and bringing them into the credit fold. There's like 45 million people in America who are considered credit invisible or credit disadvantaged. And we are doing our part in a small way to bring them into the credit fold and help them build good credit score.
Yeah, that's great. That's great. And I know it's all very personal to you as well, based on your opening remarks. Brandon, why don't I turn it over to you, just to expand on that a little bit more in terms of the lessons learned, right, from the pandemic as it relates to financial inclusions, and what are we seeing in the recent, couple of months from, financial organizations really looking to support advancements in this area?
Yeah, thanks, Janet. I think it's clear that the pandemic adversely impacted lower income communities, stemming from, longstanding issues with our broken healthcare system. And I think the same is going to be true for impacts of climate change, right? Taking the recent situation in Texas as an example, right? The storm didn't discriminate, but because of the aging electric grid and the water infrastructure, lower income communities were definitely left without power and water for a lot longer, thus, more greatly impacted. And that's not, that's just one example, right? There happens to be, the FEMA is changing, another example where, financial firms have to really be thinking about how they're supporting their customers on a going forward basis. Is FEMA is changing all their flood maps, right? And middle to lower income communities will be mostly will be the most hurt by these changes, as people's properties will, and some will be figuratively and in some cases literally underwater. Let alone the new premiums that come along with being now put into a floodplain, that they won't, the rates are such that they won't be able to afford them. So, I think there's quite a few lessons to be learned. I think one, from a financial services institution perspective, one of the things that came out of the pandemic is and a focus on a going forward basis is operational resilience. And so many financial institutions, they had to stand up their forbearance programs quickly. They had to adjust their collections activities. And, a lot of that was sort of manual brute force. So those institutions are currently industrializing those processes for the next event or trigger, like a climate event. And I think firms are also evaluating, and this really gets back to, what are they doing to start the plan for and make sure that they're promoting financial inclusion, is evaluating their models to promote more equitable outcomes, or addressing some of the risk of bias to promote more fair lending, as well as, more compassionate collections as part of their overall process of operationalizing all these different activities that came out of the pandemic.
Yeah. Well, thank you for that. Now I'm going to go back to something, Lincoln, that you touched on, and that was all about, data measurement, and source of the truth in reporting. And so I know we've seen stakeholder expectations on ESG, both the disclosures and the communications continue to evolve. And companies are carefully navigating these expectations when they make statements, and have found a tremendous need for robust internal controls around data collection and reporting of all of this sustainable information. And so, why don't we dive in a little bit deeper in terms of your company, Cleartrace, and how your software actually helps clients with managing, that data, those disclosures, and the quality of what they are reporting.
Yeah, with pleasure, and great comments from Kalpesh and Brandon there on that previous point. I'll go back to what we started off with, Janet, in terms of the fact that so many entities, companies, municipalities are now starting to target carbon footprinting and the amount of renewable energy they use. The problem being that you have well-intentioned but inexact vocabulary. And this can't last. And it can't last. And at some point, there'll be a backlash against vagueness, political correctness, greenwashing. What we do is we are able, through a patented software, to collect high quality data from the sources of generation of all energy, but particularly renewable energy. We're able to do the same thing from the sources of consumption, so buildings, factories, as well as monitor and manage the actual flow, if you like, of that electricity. Digitize it and tokenize it so that each megawatt hour has its own immutable birth certificate that is transparent, immutable, provable. It's inexpensive to manage relatively for audit, for data analysis. And most importantly, it can show stakeholders that when someone says, I am 100% green, first of all, there's provable data that can show that. And secondly, it enables matching that is the real key to changing the marketplace. Right now, you have many entities saying we are net zero. And what they are doing is they are offsetting peak consumption of electricity in inner cities where there is really only brown electricity available. They are offsetting that with renewable energy credits that may be bought in other locations at other times, which frankly, net zero, if you use the terminology vaguely, yes, your megawatt hours are balanced, but in fact, you are not changing the equation at all because green energy is being produced somewhere which does not apply to downtown locations. And I think that links very well to the previous topic that Kalpesh and Brandon were talking about. Very often it's the poor, it's the inner cities, it's these areas that are the disadvantaged that are not seeing the changes there. So our process, which collects data, digitizes it, tracks it, provides a real-time renewable energy and carbon footprinting process, enables 24/7, 87, 60 hours a year matching, really does change the system that will move the marketplace. And to Brandon's point, again, I'm picking up on an interesting point he made there about green bonds and sustainable linked lending. Again, it all goes together. It matches in with the disadvantaged communities and the equity. Woeful lack of data in the green bond market, in the sustainable linked loan market. If you can put metrics on the current level of green energy and carbon footprint in a particular company, a particular locale, and then target it to improve, and you are matching your consumption with production from that region, you actually change the world, and that improves the lot very often of the disadvantaged and the vulnerable. So we're excited about what we're doing. That is the client traction we're getting, which are people who are seeing this is the next evolution of data transparency and consequently change. And I think it is a wave that's coming. It's a massive marketplace. It's if you like, it's a non-well-served data market as big as the foreign exchange market. It's global, and I think globally it will change things.
Sure, and I think again, it's at the perfect time to be coming to market when the expectations are at increasing every single day. So Brandon, I'll come back to you in terms of just what you're seeing on the client side, right? So to Lincoln Future customers, in terms of what they are, what you're seeing companies consider in terms of meeting these, increased expectations on disclosures, on reporting, and on the validity of data. So going back again to this one source of the truth.
No, absolutely. I mean, links to supervisory expectations and regulatory requirements are certainly increasing, with just taking the Task Force for Climate-Related Disclosures as an example. I think it's now specifically referenced in over 30 policy, supervisory, regulatory instruments in over 15 or more jurisdictions around the world. And so targets set by these financial institutions are shifting from goals on additional sort of green financing, which is what I think we saw the commitments at the outset being done, to really active commitments, which is a little bit different from what Lincoln was referencing, because it's about the financial institutions' portfolios and decarbonizing those portfolios. So it's really the counterparties of those institutions, which may be one of Lincoln's clients. And getting that data and information about what their emissions are is critical, right? In order for you to, not only help transition to a lower carbon economy, but to make strategic corporate decisions around your portfolios and what you want to invest in. So I think the good thing is that some firms are working together through the help of some of their trade associations to collaborate on how to improve the consistency and robustness of their disclosure frameworks like TCFD. And I'll just give one example. The IIF Institute of International Finance and the United Nations UNEP-FI, their finance initiative, with our support, conducted a joint effort for banks to conduct a pilot program to share their perspectives on leading practices for developing, designing, and delivering climate disclosures, and to really identify areas, for improvement. Because the comparability across the current disclosures, it can be very difficult for stakeholders to interpret. And in fact, some of the actual metrics that may be disclosed, you could, just depending upon what an institution might, include in their numerator and denominator for the same type of thing, come out with drastically different results. And therefore one company looks worse off than another when in fact they're not. And so I think the result of that effort was great because it created a playbook to sort of highlight what good looks like. And they're in the process of starting phase 2 to dig deeper into the metrics and create sort of templates and exhibits to really make it even easier for comparability across reports and financial institutions to key stakeholders, including the investor community.
Yeah, no, I mean, I know, Brandon, you and I have talked in the past about, this is the time that we've been waiting for, where firms such as ours, right, can kind of get in the midst of all of this and help with that consistency, comparability, across various industries and sectors. Kalpesh, I'm going to come back to you. So, as the CEO of Deserve, with a company that, has such an important position in the ESG value chain, what role do you see for your organization in facilitating greater transparency in terms of disclosures as it relates to your business as well?
Yeah, so I think we pride ourselves in transparency in terms of pricing, in terms of if you were to read a cardholder agreement and the fine print, banks thrive on fine prints and, footnotes. And as long as, we are very transparent with what you get in terms of rewards, how do you build good credit, what is the interest rate, what is the fee? So bold letters, taking CFPB guidance on easy to understand, easy to read financial disclosures is the way to go. And I think, regulations aside, marketplace has spoken in the last 5 years where companies that have these ESG focus and their values are aligned with the consumer. Consumers vote with their feet, and they are doing business with companies that talk the talk and walk the walk. And it's being reflected in their increasing revenue and market capitalization. And that's a very powerful market force that any regulations can match. If you're seeing a Tesla worth more than all of the car companies in the world combined, whereas these other car companies are doing lip service and launching compliance cars, that tells you something about where the consumer is headed and what people want from corporations. So I think that alignment of values with your end customer is very important, and treating them with fairness and transparency is also very important, because nobody likes to be surprised with an additional fee. And Apple is doing that in credit card. They're bringing transparency on rewards, on interest, on fees, and doing right by the consumer. And we are in the same sort of vein as Apple is in the credit card industry.
Oh, that's great. I mean, you shared with us when we were preparing a great story about one of your products, and with links to specific rewards programs. I don't know if you wanted to expand upon that at all.
So yeah, I think you can have, we have been increasingly approached by a number of folks who want to redeem the rewards towards environmentally friendly sources, if you will. So if you can buy carbon offsets with the credit card rewards that you earn, and each person can have calculation of their carbon footprint, and they can offset it by rewards from the credit card and buying the carbon offset. So things of that sort are happening in the industry where people are using payment mechanism to drive certain behavior from consumer as well as companies.
No, that's great. And again, I expect to see more and more companies following suit and doing the same, and reporting out how they're doing good through many of their products within financial services broadly. Let's turn a little bit towards technology. We touched on that a bit already, but we touched on the concept of technology being a real engine of growth for change around different topics within ESG. And so, would love to hear from each of you on how you're seeing the technology enablement, both inside your organizations and in the broader ecosystem, really impact the sustainable finance agenda. So, Kalpesh, why don't I come back to you on that? And really, it's about the technology as the engine of growth on the sustainable finance and the ESG agenda.
So, yeah, I think, we are digital, we are mobile, we are API, and we are cloud-based. So when you combine these four things, it is a technology-driven, ESG-focused agenda where if you look at direct mail, if you will, you get every, mid-sized bank to large bank sends hundreds of millions of direct mail, and you get those things at your home. That's the primary mode of acquisition. 50% of credit card acquisition happens through direct mail. You get this envelope and it has, your code, and you go and apply. That's wasting so much paper and, negative carbon impact on the economy. So you talk about digital. If you have entire digital experience from start to finish, you are helping consumers at lower cost acquiring customers. Then if you're in the cloud, you don't have these redundant data centers and servers, and and then you are in the mobile, you sort of I remember 5 years ago, I had to send a fax to one of the credit bureaus for some dispute on my credit profile. I had to find, how to send a fax. I went and Googled it and found some e-fax thing. I mean, if you think about technology can enable these experiences where banking is a heavy paper-based industry. If you can reduce the whole supply chain using technology, it is creating better customer experience, lower cost to serve, and overall better for the environment.
That's great. Brandon, I'll turn it back to you. Obviously, we see lots of clients across the different sectors within financial services, but where are you seeing technology really as a engine of growth again with sustainable finance and on this topic?
Yeah, I think technology innovation's always been a driver of change for helping our society sort of move towards this lower carbon economy. And I mean, I guess I'll take one step back, and I remember when it was nearly impossible to make renewable energy projects like solar affordable without, significant utility or governmental incentives. But now, because of technology advancements and everything else, as far as the creation of solar panels and the like, the paradigm's shifting, and in some situations, the aging power grid that we talked about in Texas actually, in some situations, is now the backup power for individual homes or a commercial property. So, that's just as a backdrop. But technology for our clients is now really being used to better measure and monitor the ESG activities across their firms. For tracking, like we discussed, the commitments to disclosures, and leveraging technology platforms like Lincoln's Cleartrace to full-blown ERP systems that are incorporating, ESG into their platforms on a going forward basis. And these ESG platforms are also being built to help companies make better, more informed business decisions, right? Which is really key. And it can be around potential acquisitions, or it can really be to help improve their own company's ESG related scores. For example, there's some intelligent technology platforms that can, take in data like Refinitiv and other ESG rating data and information and benchmark companies, ESG parameters to perform sort of a view of how they look like versus their, their competitors, and they can, identify potentially best practices on ESG reporting, or really get to the point where they can better target how they can improve their overall score based upon the information that they're getting back through some of the technology platforms that are out there today.
Yeah, that's great. And Lincoln, you've talked quite a bit already about data. So your perspective there in terms of what we're expecting to see, the technology drive, kind of in the near term as it relates to this important agenda.
Oh, look, thank you, Janet. And I think Brandon makes really good points. And obviously, you and he as E&Y, really great perspective on this. But I would say, first of all, I think, yes, we're right to look at technology as a potential major lever in a solution here. We've got a big equation to fix, and technology has been recently and will continue to be a major lever in fixing that. I think it's important that we keep societally to keep evolving our ESG sensitivity and care and culture, because that will drive it. But then hard and fast to your question, the cloud, IoT, AI, ML, blockchain, all of these things are coming together, and the art is to take all of those different skills and use them in the right way, which our ESG sensitivity is driving us. And I hope we're doing that at Cleartrace. It overlaps a lot with certainly what Brandon's saying, and Kalpesh to some degree as well. And I think what's the next phases? I think the next phases is, first of all, a higher expectation from society stakeholders, whether that's users, consumers, shareholders, bondholders, a higher expectation of good information being used, again, I'm going to paraphrase Brandon here, to make good decisions in business in terms of intelligent economic decisions, intelligent societal sensitive decisions. If you have good data, and then you use technology with the other layers, the kind of things that we're playing with now in terms of machine learning and AI and risk management and optimization, I think we can continue to expect technology to be a part of the solution. And I think we should all expect technology to be part of the solution. It has been in so many other aspects of our lives. This big challenge for us all today, I think it will be part of the solution. And I'm fundamentally optimistic about it, as long as people keep thinking the right way.
So I'd love to ask our panelists one last question. So we have thousands of folks participating today with us at the Montgomery Summit. So just any words of advice coming from each of you in your respective positions at your companies in terms of the focus in the upcoming months, and hopefully coming out of this pandemic, as to what we should be focused on as it relates to ESG for our respective corporations in the industry. So Kalpesh, why don't I start with you?
Yeah, I'll just go back to my earlier point about it has to be part of your core mission as a company. It can't be a compliance tool or some position you created to check the box, because it's no longer sort of a sideshow, it's the main show. So we need to treat it as such, and you have to embed it into your day-to-day business and how you do business. And that's how you're going to get rewarded both by your customers and by your investors. So all the stakeholders are going to value you more if you are embedding it into your core mission.
Thank you. Lincoln, final thoughts?
Yeah, look, very similar. I think Kalpesh makes a good point. First of all, I think culturally, ESG gets harder and harder to separate. It's a cultural approach. And in fact, though, the Venn diagram overlaps of all of the elements there. And so I think we need to keep thinking the right way. And then the second point I would say, which is clearly the angle Cleartrace is approaching things from, but across the overall ESG world is, let's have more transparency and real data. So the first stage has been people moving to make the right statements, the right thought processes, the right announcements. Now let's drill down into that a little bit and have some data that genuinely shows things moving, the ability to target important metrics and achieve them. And I think that way we really start moving things. So that would be my takeaway suggestion, Janet.
Thank you. And then lastly, Brandon?
I like the way that Kalpesh put it. It's the main show. So I guess what I'll say to that is, get involved, because it's going to take an army to actually accomplish what we're going to try to accomplish over the next 20 plus years to really transition to this lower carbon economy.
Well, that's great. And I do just want to thank each of you for joining me today. It's been a great discussion, and I look forward to hearing more about each of your organizations in the months and years to come in terms of the difference that you're making on all of these important areas on the ESG agenda. And like we've all said, it's both the responsibility of organizations, public and private, and individuals to make sure that we're building a better world. So thank you very much for your time. This will undoubtedly be one of the most important journeys of our lifetime. And so thank you very much for joining. And I look forward to seeing you all soon. Thank you.
Thank you
very much.
Thank you.
Take care. Bye-bye.